Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending January 26, 2024. I'm President Brent. Thanks for tuning in. Well, this week's theme, the consumers still seem to be very strong, which has given us strong GDP readings. And as you'll see in a second, we've had strong economic data coming out from the middle of this past week towards the end of the week. And that, of course, is driving indexes to all-time highs. So why don't we jump in and just kind of take a look and see how things fared for the week. As you can see here, everything was in the green. Year to date, the Dow is 1.1. It's bringing up the rear, but the only one that's not in the green is the small cap. It was up this week, actually the most, but it's trailing everybody else a good bit. NASDAQ obviously leading the way. You can see I'm still concerned about this PE ratio. We've got the trailing and the forward are about the same, but it's over 22. And in my mind, that's way too high, given even with knowing that interest rates are coming down, I still believe the valuations are very stretched at this point in time. Dividend yield, almost just slightly under 1.5, 10%, or the 10-year Treasury, over 4% and holding it at about 4.14. Earnings yield in the S&P still at a 4.49, let's call it 4.5%. Over the 10-year Treasury, that's a nice, strong, solid 35 basis points because the 10-year Treasury is still at 4.14. The real yield is 129 basis points when you factor in inflation. So there's still a yield outside of inflation. Current VIX, very similar to last week. It's still staying in the low 13, still a young teenager here. We got to be careful coming up. And what we've got here in the coming week is some strong economic data going to be hitting the wire. This past week, as I said, we did see the S&P Global manufacturing jumping back into expansion territory, but just barely. It came in at 50.3. Remember, anything over 50 is expansion. And that's the highest level it's been since October of 2022. Okay. The services S&P Global PMI came in at 52.9. All right. Meanwhile, we saw the U.S. GDP come in at 3.3%, well above consensus of 2%. So over this past year in 2023, we've seen the economy grow about 2.5%. That was up from 1.9% in 22, right? And then we got the core PCE, that's the personal consumption expenditures. That's the Fed preferred gauge for inflation. It was up 2% in Q4 of this past year, but that's right in line with expectations. Okay. Personal spending also rose 70 basis points in December around the Christmas holiday season. That beat expectations. So, and we had a little bit of an upside surprise in jobs. It rose 70 basis points in December, also beating or coming in strong. So these strong readings, it did tend to move the 10-year Treasury note back up a little bit. As of March, or as of this past week's close, the forecast for a March rate cut for the Feds is sitting right around 50-50. Okay. Keep in mind that about 4 weeks ago, it was sitting at 80%. The reason why it's dropped down is because we've seen such strong economic data. Okay. You can see the best performer for the week was energy. Worst was discretionary. And then the performer for the year, communication services. Worst is still utilities. Again, we've still got about 4 or 5 days before we end January. But all in all, a very strong start. Momentum continued to carry us over from Q4 of last year. One other point I'll make, and I go into more detail with our members, but we're seeing a yield curve, and you can measure it with the 2s over 10. That would be the 2-year Treasury T-bill over the 10-year note. Or you could do 5 and 10. You could do 10 and 30. But the common accepted is 2 over 10. Treasury, the Feds tend to use the 90-day over the 10-year. But either way, the uninversion of the yield curve isn't necessarily a good thing. We've had a negative yield curve for quite some time, which tends to precede recession. And if you guys remember in 22, they were calling for a recession in 23. It never came. They just keep pushing back, oh, we're going to have a recession. And now we could not see a recession at all, according to some analysts. I do believe we're going to see some ugliness sometime this year. And then in 25 or 26, it's going to get really ugly. And members, you've heard me talk about it, and we'll be ready for it. That's how we make really good money in some of the ugliness of the markets. But if we look at this, back to the point I'm making, when the yield curve moves positive again, the markets have dropped almost 50% of the time over the past 44 years when that's happened. Okay. In fact, the yield curve being inverted, um, the last two drops, the markets, the last time it went normal, we've dropped over 10%, right, over a 12-month period. So generally, we see a slowdown, usually occurring about 9 months after the maximum yield curve inversion, which happened in the summer of 23. So that would imply we should start to expect to see a slowdown here in February and March. And that's exactly what I'm suggesting we're going to see. All right. Doesn't mean we're going to get a bear market. I just think the markets are going to slow down just a little bit. But this coming week, we got a lot of activity coming up. Members, I'll go through more detail with you for what to expect this week. But just understand, we got the beginning of the month jobless claims on Friday. We get the Feds on Wednesday with a policy statement. A lot of activity with earnings, some of the mega cap tech coming out. So we can see some movement in the market this week for sure. And then, of course, if we come over and look at the European markets, you can see everybody was in the green. Euro stocks, FTSE, CAC 40, DAX, all in the green. The only one in the red year to date through the first 3.5 weeks or so of this new year is the FTSE. The ECB kept their interest rates unchanged. They're at record highs for them. And they reiterated their monetary policy would stay at sufficiently restrictive levels for as long as necessary. Same thing the Feds are saying. So they're kind of lining up with each other, right? We did see the Eurozone business activity shrink for an 8th consecutive month. It shrank at a slower rate, but it's still below 50. The Eurozone composite PMI came in at 47.9. Now it's at 47.6 in December. So it rose 30 basis points, but it's still very low, or 30.3 tenths of a percent, but it's still below 50. Okay. In the UK, meanwhile, their business activity rose more than expected. The preliminary, or their S&P Global Composite PMI, which puts both manufacturing services together, came in at 52.5. It was at 52.1 in December. So let's just say over in Europe, they're pretty much stagnant to slightly down. And I think over the next 4 or 5 months, we should see them outperform the U.S., believe it or not. Then, of course, if we look at the Asian markets, you see the Nikkei is down just a little bit, but year to date, it's leading everybody. It's up almost 7%, 6.83%. China finally had a week in the green, right? Hang Seng in the red, or in the green also, but year to date, they're both in the red. You know, if we look at Japan, they've got at their January 22nd, 23rd meeting, you know, the Bank of Japan maintained their key short-term interest rate target at a minus 0.1%. They're one of the only central banks that are keeping interest rates negative and putting stimulus into the economy, right? They're going to continue their yield curve control policy. They did revise down their consumer inflation forecast. They said CPI for 2024 will be at 2.4% year over year. That was down from 2.8% forecast this past October, but still over 2%. And what the Bank of Japan is saying is they want to see it stay over 2% for an extended period of time before they start ending their stimulus policy and this yield curve control. Now, speculation was they were going to do it in January, which drove the yen higher. They backed off and the yen came back down again. Members, we'll go through more detail on this, but I do believe there's an interesting play setting up there. Members, you guys know what my thinking is on that. Chinese equities, as you can see, in the green for the week. They advanced, really the PBOC, the People's Bank of China, said it's going to cut their reserve ratio requirement. They call it their R cubed, or RRR, by 50 basis points. That is their way of putting more money into their economy, right? That means banks can lend more money should they decide to do so. But this is the first reserve ratio requirement cut that China's done this year. But what's still holding the economy down there is real estate. This is just a huge drag on their economy. I think it's going to take a while for them to come out of their doldrums there. Okay. I'm going to shift you over and show you the charts real quick and just kind of show you how things are shaping up and how we're just continuing to just blast higher, right? Let me get this over here like this. Let's get this off the screen. And it'll take another 5 seconds to come up on your screen here, but it should be popping up here shortly. All right, so what you see is the E-mini S&P 500 futures. You can see on Friday we had an intraday high, all-time high, with the SPX up about 2.5%. All right, you can see where 2023 closed. We hit a low here the first couple of weeks of the month. We're in the red, but we've had a pretty good strong rally up through then. But you can see we're setting up for divergence. This tells me that over the next week or two, we're going to start to see some softening in upside price, right? Or sideways or consolidation. And of course, if we come down here and look at the strongest one of the bunch, NASDAQ 100 futures, you can see it hit a high over here on January 24th, up 4.64%. I think it's also a bearish divergence is setting up. So that suggests more softness in the NASDAQ 100 futures. And if we look at the Mag 7, which is the strongest of the bunch, right? You can see here that it hit an all-time high on January 24th, and it's kind of settling in here. It was up 7.78%. Those are those stocks that are pretty much pulling the rest of the market up, okay? Up 7.78%. I think valuations are stretched. They got a high bar to hit for earnings coming up this week. We got a lot of them participating in their earnings. So we could see some real interesting stock movement there. And let me just show you, benchmark that against the equal weight SPX. If we look at the equal weight, you can see here that we're still in the red at Friday's close for this year, right? We ventured slightly in the green, but I mean just pennies, but we closed in the red, equal weight. So that shows you the power of these Mag 7 and some of the others that are out there. And you've got about 10 stocks, add a couple more to these Mag 7 that are accounting for about 70 or 80% of the gains in the market. Okay. So just understand this cannot last. It's not healthy. It's normal because when you get this, I've used the term irrational exuberance, it can last for a while. But I do believe we're going to see some backfill here over the next 2 or 3 weeks. And then I think in April, May timeframe, late March, April, May, we're going to have probably a little bit of a pullback or possible correction, right? Over 5 to 10%, sometime in March, April timeframe. Until then, I think we'll pull back a little bit, rest, and then make another new all-time high before we pull back. Okay, that's a little bit about what I'm seeing. If we look at the Russell, it's still in the red year to date, as you can see. It's the only one and these are small cap. Small cap is just not doing very good since we started out this year. It's not participating as much in the rally as I would like. And if we do a ratio chart of the equal weight to the SPX, just to show you, you can see here that the Mag 7 is driving everything because everybody else is not playing along. And you could see we hit 2024 lows on January 25th for everybody else in the equal weight, if we were to equal weight the SPX, right? So we need much more strength across the board here to see this thing have legs and to last, okay? That's kind of what I'm looking at here. If we look at volatility, you can see volatility, even though we've seen the markets move up, volatility really hadn't come down. The last time we saw these lows was back over here in early December, but it's slowly been making higher lows and higher highs. Very stealthy, right? I do believe we're going to get a pop up here sometime in the next 2 or 3 weeks. And I will remind you that the last 2 weeks of February, traditionally the worst 2 weeks of the trading year, if we go back 30 or 40 years, right? So that's still out in time a little bit. But I do believe we're going to see some backfill and some settle in on price. Of course, if we look at treasuries, the all-important interest rate, you can see here how treasuries have been pulling back, which means interest rates have been moving higher, right? I just have to adjust this a little bit here. Let's put the actual lows down here. And I got to fix that. So this would be on January 25th that we made these lows. In the bond market, slightly a little bit more than 4.07% to the downside, which means interest rates are just moving higher, right? And if we look at the 10-year rate, it's very evident in looking at it that we're coming in off the lows here, right? Here's the 10-year rate moving back up. In fact, you're looking to regain the 50 EMA, right? I do believe that the rates are eventually going to move back lower again, but I think that's going to be way out in time, right? Keep in mind, the forecast is not for a rate cut this next Wednesday. And then there's no Fed meeting in February, and then the next Fed meeting is about the middle of March, and there's about a 50-50 shot. So if they don't hike, because the markets have a 50% probability that they will are cut, and the markets have a 50% probability they will, that's going to give us some backfill, right? The markets are going to take that off the table. And then you'll see the next meeting after March is not in April, but in May, right? So we skip a couple of months early in the year. So we got a meeting this January, then March, and then May, right? And the forecast of a rate cut in May is almost 100% right now. Right? So we're going to see how all of this changes over the next couple of, or at least this coming week. You're going to see some big changes in that, and that could affect the markets. And if we look at the currencies, the dollar has been drifting higher, and it's kind of stuck right here, right? I got to adjust this too. But you can see here that the dollar has been moving off the lows because the U.S. is doing very strong and the rates are still high, and that helps the dollar. Okay. And of course, if we look at the euro, I like the euro longer term. Right now, though, it's not a trade, and I just got to adjust that also to hit the lows, and then I'll update these for our members Sunday evening. But you can see here how until the euro gets over the 50, I'm not interested in a long. I don't want to short the euro. And then, of course, the Japanese yen. It's running sideways to down. It's going to be driven by the Bank of Japan, right? And eventually, when they announce, you're going to see this thing start a long run to the upside. This was the expectation that the Bank of Japan would cut their stimulus and get off their yield curve control. And they didn't do it, and you saw what happened. So I would expect this to happen here sometime in Q1. But longer term, I think the yen is going to be a positive play. Gold, if we look at the gold chart, you can see here it's doing kind of pretty much what I said. It's just drifting right now. Longer term, I'm bullish gold, but now it's good for a couple of trade strategies that we run in our user group. You guys know your members know what I'm talking about. But this is kind of where I'm sitting here for gold. And then, of course, if we come down here and look at energy, we look at oil. It's really a great setup here in oil for running flies. And you could see my forecast for oil was in the 60s over sometime in the next couple of months, 2 or 3 months. This is just a run up right here because of the strong economy. China has been weak, and when China tends to be relatively strong, we see energy start to move strong too, much like copper, right? Nat gas, well, nat gas here, you're going to see here, going to be choppy. I don't see it going much lower than this, okay? So that nat gas right in this area here is not much of a play. The Biden administration is going to be cutting a lot of LNG ports and nat gas exports, so that will affect natural gas here over the coming months in anticipation of that happening. All right, everybody, that's just a real quick and dirty update on where we're sitting here. Members, I'll see you Sunday evening for our weekly market watch. Everybody else, enjoy the football weekend tomorrow. Have a great week, and then we'll see you next weekend. If you're not a member, I highly encourage you to come in. We're getting folks all the time coming into our user group. Have a great one, everybody. I'll see everybody later. Ciao now.